Coming back to the Great Britain pound US dollar. This was the Great Britain pound US dollar buying the dip into 50% and 61.8 retracement, but also the same chart shows how to use or helps us identifying or how to use the Fibonacci expansion tool. The Fibonacci expansion tool, you can find it here on the tools. This one, like this, and you can apply this tool, or you can use the Fibonacci retracement and edit it like I showed it a bit earlier as you want by adding the new levels here and finding the extension or the extension level. The Elliott wave theory again says that the minimum distance that the third wave or the extended wave to travel is 161.8. Again, the golden ratio, 61.8, 161.8 of the first wave. So if we take a Fibonacci retracement and we measure this tool, we check then the 61.8, we take a trend line and we project that one from the end of the second wave. We form an educated guess where the market might go for the third wave. And it did went for the third wave, fourth wave, fifth wave, and that's it. So the 161.8 helps identifying a target for a particular trade. Another important levels to consider are 123.6, 138.2, especially when you deal with patterns. This is true from a market geometry point of view, in the sense that often when a market is able to rise in a bullish trend, but the same principle is valid on a bearish market. When a market is able to rise, puts a series of higher highs, higher lows, higher highs, higher lows, but often higher highs, higher low, and then the new higher high fails to break 123.6, 138.2 area. When that happens and the price comes back into the territory of the previous higher low swing, the tendency is, or the pressure builds to the downside, that the market will try to break these lows, and it did. The same thing happens here. It formed a new higher high, a marginally one, didn't even reach the 123.6. It came into the territory. The bias here now transformed into a bearish one, and it broke low. It made a new low. And this same principle is the one responsible for double tops or triple tops, as the market here reversed, failed, or made a marginal new high when compared with this one, and you have a double bottom, and the pair never looked back. How about when the market has the power to expand more than 138.2? Now that's bullish in a rising trend and bearish in a bearish trend. So as a continuation to the example of the New Zealand dollar, US dollar, what we see here is the market making a new higher high, crossing through the 123, 138 area, closing above, which is bullish, piercing the 161.8. Whenever you see that, that's a bullish case. It implies more aggressivity, and we should not be surprised that another Fibonacci ratio, 261.8, came into place. Sometimes we also see 423.6 and so on, especially when we trade with Elliott waves. Last but not least, a concept that many traders use, especially on the equity market, especially when they interpret the stock indices, is the Fibonacci used as a time or to measure the time element. The tool is called Fibonacci Time Zones, this one from here, time zone, this one from here, and it projects on the right side all the Fibonacci series or sequence that I discussed earlier. 0, 1, then 1, 1 is 2, 1, 2 is 3, 3, 2 is 5, 5, 3 is 8, and so on and so forth. The idea is to have Now don't mind this chart that you also will see on the article, because this principle to align the stock market not recession, the stock market corrections with the business cycle. As usually a correction in the stock market follows a recession on the business cycle, or a depression on the business cycle creates a correction on the stock market. So when you see that happens, then the Fibonacci time zone allows to project future corrections or recessions in an economy if you want. So based on this correction, we can anticipate the next one, we can anticipate the next one. And if this would be all the historical data on the Dow Jones, which is not, but if this would be all the historical data, then traders would expect a new recession somewhere around the next Fibonacci time zone. The idea here is to go back in time, find all the historical data on the Dow Jones or the S&P 500 or whatever the index, measure the first corrective phase, which coincides with a recession, and then use the Fibonacci time zones to project the next Fibonacci or the next recessions or corrections according to the Fibonacci sequence. Thank you for being here and have a great day. Bye bye.